Hello, I hope this video finds you well. I wanted to proactively reach out to all of you in light of everything that happened this past week with Silicon Valley Bank and with Signature Bank that failed and prompted the Federal Reserve, the FDIC, and the Treasury Department to step in to protect depositors with deposits above the $250,000 FDIC insurance limit. One of our principles here at Forefront is over communication and noise and under communication cripples. In the spirit of over communication, we thought it was prudent to reach out to you proactively to give you important information that you need to know about FDIC. Feel free at any time to reach out to your financial advisor, myself, or our team. We're one phone call away, one text message, one email, one Zoom meeting to address any questions that you have around banking, your financial plan, retirement, etc. What's going to follow after this video is going to be a live discussion that I did with three respected bankers, one from Truist, one from Bank of America, and one from Capital One, talking about strategies that you can leverage to maximize the FDIC protection that you have. One such strategy that we have here at Forefront is our Forefront Savings Account. We're able to take your deposits and spread them amongst amongst. I apologize about that. Amongst a network of 900 banks and get you over $25 million of FDIC insurance. If you have any questions about that or you're not familiar that we have this Forefront Savings Account, feel free to ask your team. I want to thank you. I want to thank you and your families and your business for your trust and confidence in myself and our team. We're here anytime. Please feel free to reach out to us with any phone calls, text messages, emails, or if we need to schedule a Zoom meeting or in-person meeting, we're happy to help you. Thank you so much and enjoy the 40-minute discussion afterwards with three experts around strategies you can utilize to protect your money utilizing FDIC insurance. Good morning, everybody that's watching either on Facebook, LinkedIn, or YouTube. I'm excited to be here with you this morning to really provide a voice of reason because there's been some unprecedented things that happened over this past weekend. And so I thought it was important that you hear perspective from four experts that can share with you strategies to maximize FDIC protection and what you should proactively do as an individual, as a business owner, to make sure that your money is properly protected. So today joining me are three amazing bankers, Anna Sanchez of Truist. We've got Kathy Burrell of Bank of America and Alex Gonzalez of Capital One. Anna, if you would start, why don't you introduce yourself? Tell us a little bit about your banking tenure and history, and then we'll go to Kathy, then we'll go to Alex, and then I'll share some opening comments.
Thank you, Eric, and it's wonderful to be here. Thank you for inviting me. Yes, I'm a native Austinite, been in the industry for more than 30 years. Started my career at Chase Bank and moved on to Wells Fargo for about 21 years, and then did a brief time over at Texas Capital. And now I'm fortunate enough to be on the Truist team in the commercial banking group.
Love it. Kathy.
Good morning, and again, thank you for having me as part of this panel discussion. And I am a commercial banker. I have been in the banking industry for 25 plus years. The plus is holding. I started my career with Bank of America. At the time, it was Nations Bank in Atlanta. I've been with the bank for 22 years. I have also in between those 22 years, I've also worked for Chase Bank and Guarantee Bank, but I am back at B of A. So thankful and grateful to be part of this discussion.
All right, Alex Gonzalez.
Hey guys, I'm Alex Gonzalez with Capital One, and I've been in banking also 25 plus years with the plus holding, like Kathy said. And started my career at Wells, and then ended up moving through different channels at B of A, retail, and wealth management, commercial, and business banking. So I have a pretty extensive background in all arenas, and I'm pretty happy with my career. So that's my background. Now I'm at Capital One.
Outstanding. So just to kind of share briefly what transpired this last weekend with Silicon Valley Bank. Last week, Silicon Valley Bank was taken over by the FDIC. The FDIC created a new entity called the Deposit Insurance National Bank of Santa Clara. It's the second largest bank failure in U.S. history in terms of assets. The last one was in September of 2008 with Washington Mutual. Last Thursday, what we saw play out was a modern day run on the bank. Clients attempted to take out $42 billion in deposits, and the FDIC had to step in to make sure that they kept financial confidence in the system. Over the weekend, there was a lot of debate whether or not the FDIC would protect uninsured deposits over $250,000. Luckily, there was a session that was had with the Treasury Secretary, Janet Yellen, the chairman of the FDIC Corporation, the president, and several folks from the Federal Reserve, including Jerome Powell. And they all decided that it was prudent to demonstrate the strength of the financial system, that they stepped up and protected depositors above the $250,000 limit. Here's what we know about Silicon Valley Bank, and also what ended up happening later on the weekend with Signature Bank. Specifically, both of these banks were concentrated in the technology sector. Specifically, Silicon Valley Bank and Signature Bank was concentrated with cryptocurrencies. As the economy has shifted, there's been changes to interest rates. Technology companies have went out of favor. Lots of challenges in that sector. Today, we're having a discussion where we're going to talk about FDIC, because it's important for business owners to know exactly how to get the maximum protection on their money. And we've got three extremely brilliant bankers to talk about that. So I don't know if anybody wants to open us up, but can anybody tell us what the heck is FDIC insurance and why did it come about? Any one of you want to take that?
So FDIC Insurance is your federal deposit insurance company. And the purpose and the premise of the FDIC is to ensure consumers and businesses deposits on an aggregate level. So if you have, for example, 5 accounts at one institution, they're not insuring each account. They're taking the aggregate of those accounts and they're insuring them up to $250,000. And so I'm going to kind of digress, but I was really excited to hear that the decision was made to cover those deposits, because if it had not, I think that would have further demonstrated that there is potential instability in the economy and in our government, which in this case is FDIC Corporation. And so that was something that was needed. And I'm speaking personally. I'm not speaking on behalf of Bank of America. So I do want to say that. These are my opinions, but I think that was the right thing to do. And that is one of the many things that I think has kind of, if you can use the word calm, it has calmed things down in the past. I'm going to say 48 hours.
Alex and Anna, do you guys want to add anything to that?
No, and looking at it, I mean, Kathy explained it pretty well. And this thing was founded in, after the Great Recession. So if you look at all the years of history over it, I mean, it started at, 2,500 and 5,000 was the coverage back then. And then it's increased, over time. Like I think in 1980, they increased it to 100,000, when we were still part of the banking system. And then in 2010, they increased it to 250. And it treats each thing as there's different categories that fall under the FDIC.
Yep. Fantastic. I'll also add to this is that FDIC was born out of the 1933 Act that basically was put in place to provide stabilization and to infuse confidence into the financial system because of the Depression. And we've only seen it come into play a few times over its history. One was the Depression. Two was the savings and loans crisis. Three was 2008, 2009, and now we're seeing it come into play here over this past week with Silicon Valley Bank and with Signature Bank. So it's really, really, really interesting. So have any of the four of you or any of the three of you been a part of a bank that's failed?
Yes.
Okay. Tell us about your experience, because I want to pause here and just take a second and say that our thoughts and well wishes go out to the employees of both Signature Valley Bank, Silicon Valley Bank, and Signature Bank, because getting taken over by the FDIC is no fun. So Anna, do you want to talk about your experience, and then we'll kind of continue to go forward?
Yes, actually, 5 years into my career in the late 80s, early 90s was the savings and loan crisis. And I happened to be working for one of those savings and loans right there at 9th and Congress here in Austin. Not just a savings and loan crisis, but also a real estate bust here in this town. It was a terrible time. And of course, the savings and loan failed. Everyone was sent in receivership. And the next thing we knew, within a few days, Chase Bank, formerly known as Bank One at that point, came in droves. I remember sitting in the lobby and having this about 30 people walk in with Bank One T-shirts on and just completely took over the SNL I was working for. And pretty much everybody was let go except for myself and two other employees that at the time had to do manual data entry of all of our customers into the then Bank One systems. No one lost money. Even in that situation, there was, the Federal Deposit Insurance Corporation, the RTC at the time. I mean, there was a lot of panic, I think, during that time, just because of the state of the entire economy in state of Texas, in particular in Austin, and it was quite scary for those of us that worked. Our livelihoods were being threatened. Some of us had to go and do other things. Fortunately, I stayed on and stayed with Bank One, now Chase, for the next 10 years. So that our customers were taken care of. It was scarier than this, I think, during that time, up until the financial crisis in 08. But yeah, it was a great and terrible experience at the same time.
Yep. I can totally relate. I was part of a bank that was taken over in 2009 through the whole 2008, 2009. And the bank I worked for was in Florida at the time. The name of the bank was Colonial Bank. It's a $26 billion bank failure. And I remember being on a golf course on a Friday with the business client, and my BlackBerry buzzed. That'll date us going back. My BlackBerry buzzed that the FDIC had taken over the bank, and I walk in, and the FDIC is there, and in an instant, everything changed. what we knew was gone. So definitely my heart goes out to the Silicon Valley Bank and Signature Bank employees. Okay. So the most important thing that people want to know at this particular time is, what sort of programs are your institutions offering to get folks additional, FDIC insurance over and above the $250,000? What sort of strategies can people implement? And I'm going to start off with you, Anna, then go to Kath, and then go to Alex, and then I'll share last. So what sort of programs is Truist offering right now, and what sort of steps should I do as either an individual or business owner to make sure I get maximum FDIC coverage on my money?
First of all, and I'm sure my colleagues on the screen here all offer the same types of services, but we each all have verticals within our organizations that help support those conversations with our customers, whether it be individual or business. One thing that I would recommend the listeners is have a relationship banker. Have someone that can help guide you through your particular organization, whoever you bank with, and to help support the ideas based on what your personal strategies are in terms of cash and investing and so on. Talk to Eric. Eric's he's a great resource as well. But some of the things at Truist, what we're doing, first and foremost, we have expedited our treasury and cash management onboarding process for specifically Silicon Valley Bank. So we're stepping up to kind of help support their operating needs. And we are also helping with our investment group, our experts that can help talk about their investment policies and strategies and identify other ways to invest that are conservative in nature. They may not be FDIC insured type products, but they are conservative in nature, such as treasuries, government-backed securities, things like that, that our investment experts can help guide through. I think it's also important to just have a team of experts. Personally, I have an investment advisor, an attorney, a CPA, and a therapist. No, just kidding. But
they're all one person.
Move you through all of these ideas and choices, because everybody's got a different outlook. They have different goals. So your strategy is not going to be like mine. So it just depends on where you're at. But we do offer all those cash for businesses in particular, cash management and treasury products that can help in being efficient with your cash management, as well as help protect in that way.
Got it. Kathy, if you want to echo that, and then also share for those who may be ignorant or lack the knowledge, what is cash management? What is treasury management? What does it really look like from the business owner's point of view, Kathy, or the individual?
Absolutely. And I definitely echo what Anna has just said. But from a cash management and treasury management perspective, the clients that we all work with, because they are business clients, there is a need for treasury management. And treasury management is resources or a tool that helps companies with the movement of their cash. And that movement could be, how do they move their money in terms of ACHs, wires, another thing is called real-time payments. But it allows business owners to really become much more efficient and effective with the timing of how they are moving their cash. And I think that any business company, regardless of how small or how big it is, should have a relationship banker where they have treasury management in place. We hope that this will never happen again, but history has a way of repeating itself. But if you have, those digital tools in place, you're able at a click of a button to move your money in a very expedited manner. So that is absolutely essential. Cash management many people have different interpretations, but cash management is also how do you manage your cash? And from a resources standpoint, I'll just speak for Bank of America. One thing that we're able to do is kind of partner also with our Merrill Lynch partners and help kind of diversify cash and how it is being managed. And so from the business side, if there's excess liquidity, if you will, we can also talk about how you want to maybe invest that money in some either rather conservative vehicles or more aggressive vehicles. But I think it's essential that business owners and individuals really form a relationship with a banker, and then inquire about what are some of the resources and tools that that financial institution is offering that will help them quickly respond and access their money, and likewise just move it if need be.
Alex.
Yeah, and for me, when I look at it, talking about what Anna and Kathy had mentioned, it's have the relationship banker, but also knowledge is power. Using the resources the FDIC has on their website, like EDI, it's the electronic deposit insurance estimator. I've had clients walk through that. It's like, look, guys, if you want to know exactly what your coverage is, here's a way for you to do it. And based on the categories that you have, it'll give you, hey, are you covered? Do you have a deficiency? So it'll tell you exactly on there. So that for me is the primary thing clients should be comfortable using, and then plugging that stuff in. Because I've done that with customers. I can't do it for them because we're not allowed, but the customer can go in there and pull the data and plug in, and just nickname it, retirement account A, deposit account A at this bank. It'll really give you a good estimate of what's covered first. And then, like Anna and Kathy said, there's a variety of different products on top of that offer you that coverage. But you also want to look at what's the liquidity coverage ratio of an institution. How strong are they? So you want to be comfortable that you've made good decisions on this.
Yeah.
And then that's my take on it.
Awesome.
Eric, if I can add one more thing on cash
Please.
management, I kind of see cash management as a sub feature of treasury management, and it primarily measures and monitors a company's liquidity and mitigates risk in some ways. It's important to keep an eye on that from a cash management perspective, because when we face these types of headwinds, your company needs to be in position to have enough cushion to maneuver through it. Mm-hmm. What I'm seeing personally is, in this situation that's been going on this past week, is there's not cushion. So when there's not cushion, that's when the panic starts, because you got to make payroll, you got to pay your vendors, whatever that is. So the cash management piece and what Alex was saying, in knowing what that cycle is within your own company, and understanding, okay, how do we get enough cushion to face these headwinds that happen. COVID was the first one that we saw, and now for some it's going to be this SVB issue.
Can either of you highlight at all sweep accounts, zero balance accounts, these sort of things? I mean, that's my background. That was some of the hot button issues. Can either of you talk about what that is, practically speaking, for an owner? And I'll kind of speak to what individuals can do.
So in terms of sweep accounts and zero balance accounts, those are accounts where at the end of the business day, any excess liquidity that is sitting in the company's operating account is swept into overnight investments. And so it is taken off the bank's balance sheet overnight. And then in the morning, it comes back on and it comes back into your account. And so those are, ways that companies can gain or make some overnight investments. But at the same time, I guess you could say one of the things that will kind of safeguard is it does take it off the bank's balance sheet overnight. and it brings it back on in the next day. And I know from a banking perspective, what I've seen, it was extremely popular in the early and mid 2000s. I have not seen people really taking advantage of that, and primarily because we have been in such a low rate environment, if you will. And so I would suspect that we may see that come back, but there's some benefit definitely to that product.
Okay. My experience at the bank and now being the CEO of a wealth management company has always been dealing with private banking clients who typically were either high net worth individuals or they were business owners who ended up being high net worth individuals. And kind of to echo what Alex had shared, one of the things we would do is sit down and go through the ED calculator, and we'd find every friend, family member, grandchild, etc. Because the second that you add a beneficiary, you can pick up another $250,000 of FDIC coverage, it's different IRA accounts, etc. And for those of you listening to the live broadcast, we've dropped in links to the FDIC as well as a YouTube video explaining FDIC coverage and the link to the ED calculator. You'll see that in the comment feed of these lives. So we would sit down and go through calculating out how do we do that. And the other thing we would do is, and we currently do this today with our firm, is we have a network of banks that anywhere between 900 and 1,000 that we can take somebody's deposits and split them among so that they're getting maximum FDIC coverage. So to me, when I saw the whole Silicon Valley Bank and Signature Bank unfold, I thought to myself, where in the heck is this person's CFO or controller, and where was the prudent cash management plan to have that much deposits in one institution without any sort of a network system to be able to spread the money? So I don't know if you guys are hearing things like that in your banks, but it's been something that I think about with our clients is, the old adage, don't put all your eggs in one basket. And, the other thing that you had said, Kathy, which was there's a saying that goes, history doesn't repeat itself, but it rhymes. So what would you guys say regarding what I'm talking about? Is it prudent for a business to hold that much cash with one institution, and should they take actions to protect their money, or does it come down to the financial strength of said institution and their financial positioning, and you really got to look at that, more so?
I think it varies by different types of entities. And, I know Anna deals with nonprofits a lot. I deal with nonprofits too, and so does Kathy. But nonprofits, they have committees, they have boards that make those decisions that said, hey guys, we need to spread this out. Because in fact, I just had a question last night from someone wanting to move here. They were asking about the sweeps. They were asking about this because their finance committee now, in lieu of this information, they're asking about it. Hey guys, how do we distribute this? How do we make this, how do I make our entity more comfortable and more secure in this arena? When we deal with business owners, a lot of them, because of the complexity of the business, they look at the liquidity ratio of the bank. That's what they're looking for. The stability is how secure are these banks? What is the FDIC? What does the Fed say about them? And what's, what leverages, how are they leveraged? All that stuff comes into play. So when I look at that, I'm always speaking to customers. It's still their decision, it's their business, but I want to make sure that I'm looking out for them.
Yeah. I think when we look at this, it's always a crisis reveals those who planned and those who didn't. And those who didn't are quickly scrambling. And I think it's imperative. I think the government, the FDIC, the financial institution, from the Fed to the Treasury, have taken proactive steps to show that our financial system is strong. But I think this is a cautionary tale. This is now the time to have a plan in place. If you didn't know about cash management, if you didn't know about treasury management, if you didn't know about sweep programs and different things that we're talking about, it's imperative. So what other advice would you guys share with individuals or business owners right now regarding their deposits at banks?
I'll chime in here. You know, and in a perfect world, one wants to think that they can, you know, spread their deposits and be at multiple institutions and be safe. But the reality of it is that, you know, there's just certain times you can't avoid that. So
Yep.
you're going to have deposits in excess of the 250,000 or the FDIC insurance level. And so when it comes to that, you know, one of the recommendations I would make is do your due diligence. Research those banks, research their capabilities, research the strength and stability of those banks. You know, what are their liquidity ratios and their capital ratios? Because at the end of the day, those are going to be a couple of ratios that's really going to be a telltale sign in terms of how strong those banks are. I know it sounds, you know, academic, but I would say even we're in a day and age, it doesn't hurt to look at their annual report. How diversified are these banks? I think that's very key in this environment we're in, that there is diversification. Just like we want to diversify on the personal level with our investments or portfolio, I think that, you know, business owners or even just consumers should also look to see, is their bank diversified as well?
And I would add, you know, Alex said it at the top of the call, knowledge is power. Some of what Kathy mentioned, if those financial reports of each of the banks are posted on their websites, you can pull down their all of that information. Some of the ratings of these banks, pay attention to S&P, Moody's, Fitch, Morningstar. All of those organizations rate your bank. So you want to look for A-rated banks. Truist is one of those. Plug. And I'm sure my colleagues are in the same boat. Kathy mentioned liquidity ratios. You can find all of that in your bank's financial reports. Again, typically on their websites. So this is public knowledge. And after the financial crisis, the government put in place these capital ratios that banks have to be able to take care of themselves. And that's why liquidity ratios are and capital ratios are so important today, is because of what we experienced in 2008. So you're going to find, you can find these and see how, the other thing is see how your bank compares to its peers. Are they better? Are they worse? And if they are, is it still good? Is it not? You know, so those are key things that lends itself well to educating yourself on where you're going to put it. Because Kathy's right. If you're spreading $250,000, you have $1 million and you spread it over multiple banks. Not to mention, you're going to have to monitor that. You're going to have to reconcile that. And do you have time to do that? You know, again, we have not been in a situation where there's been bank failures, where anyone has lost any money. So that's great news. But today we have so many more tools in place to help you make a prudent decision as to who you're going to bank with and how you're going to invest.
And again, it leads back to having that relationship with your banker, but also trust and verify. I mean, that's the whole point, is, you know, using the information, going out there, looking at, you know, did my banker relay the information? Did they relay how strong they are? Can I pull that information and prove it as well?
Yeah. I tell you, we're gonna pivot to probably some questions that are sitting in the public's mind, which is, this is the big one. I was reading this one in the Wall Street Journal. Are taxpayers on the hook for SVP and Signature Bank's deposits? What do you think, guys? Are we footing the bill for this?
I'm going to say it depends.
Yeah.
And the reason why I'm going to say it depends, and if you ever worked with a banker, we use that term a lot. It depends.
Sounds like an economist to me, but whatever.
So I'm going to say it depends, because I just read that they are actually trying to find some buyers for SVB and Signature Bank, and depending upon what comes out of that, in terms of if it's purchased, and if it's purchased at a fair market versus a discounted value, and I don't want to get too much far in the weeds, but I think if there's another institution who steps up and take over these two banks, then I don't think it's going to be at the burden of the consumer, if you will. But if not, I think there may be something where it's going to kind of fall back on the consumer. What that will look like, I really don't know at this juncture. So that's why I say it depends.
Okay.
Yeah, and I saw it go through when I worked at Guarantee Bank, and they went under the Great Recession in 2008, 2009. All the assets were purchased by Compass, so all of those accounts got moved over to Compass. So I've seen it where it was covered by an acquisition.
Yeah, I've read some reports, just to kind of, for those that are debating out there in the world of LinkedIn, YouTube, and Facebook. I've had some report. Let's be honest. Economics 101 says all costs get covered. Just depends on who's covering them. So I think the couple of things that are going on here is, number one, both Kathy and Alex outlined, this bank is going to get sold off, in either in whole or in parts. Somebody wants those deposits. Somebody wants those loans. And let's be really honest, the government's going to sweeten the deal with some sort of provisions to protect against loan losses. Let's call Silicon Valley Bank and Signature Bank what it really is: a concentrated bank, i.e., they concentrated in one sector of the economy. And coming back to the simple logic that our mothers and grandmothers share with us, don't put all your eggs in one basket. Concentration builds wealth, but diversification protects it. And we just saw how concentration played out on the national stage. So coming back to my points, number one, somebody's going to cover this. Number two, somebody's going to buy the assets. And number three, and this just to quell all this discussion, this is not a bailout. Stockholders and bondholders, quite frankly, they got the short end of the stick here, right? If you think about the order or the capital structure, they're further down on the pecking order. Depositors were protected. Stockholders and bondholders are going to take a hit here, and they already are. So this is not a bailout of any sort. So the other thing that's not being talked about from my banker friends on the call is there's probably going to be some sort of a special assessment that's charged by the FDIC to banks if there's any shortage to fund this deal. The reality of it is that, to remain compliant, we all have to pay to play. And that's just the name of the game.
So Eric, if I could just chime in, there's already an assessment that is already charged. And so what we'll see is that assessment increase, but there's already an assessment that is in place. Just to let you know that we're already paying for it. We just don't.
Sounds like a fancy condo, and somebody decided to do the roof, and nobody's going on a vacation here. So they already hit us with the special assessment. Is that what you're telling me, Kathy?
Oh, that special assessment has been there for some time. It might increase, but it's already been there for some time.
Is there anything else that you guys want to add to this discussion as we kind of get ready to wind down here?
I would just say, stay calm. Do your homework and gather your experts.
Love it. Kathy, you want to add?
Well, she took the words right out of my mouth, which is stay calm and just do your due diligence. More importantly, do your homework.
Yeah, I
Alex?
echo that. I echo that. Just like I mentioned, like the nonprofits have, the finance committees have, the board looking out for them. The same thing. Have your experts looking out for you. You know, talk to your financial advisor, talk to your CPA, talk to your attorneys, talk to your banker. I mean, have that group of advisors to help you go through this and
I'm
get
gonna
through it.
thank you. I'm gonna get ready to close this out, but I think about times like this. I think about a Churchill quote, which is keep calm and carry on.
Yeah.
The reality of it is keep calm and carry on. But the the reason why we're having this discussion today is that it's imperative that you have smart people around you, that you have a team. If you're an individual, you need a team. Your team needs to comprise of an advisor, a CPA, a banker, a lawyer, an estate planner. There is nobody that succeeds in life without a team. And if you're a business owner or you're a corporation, you have a team of people internally in your organization. You need to have a team of people externally. It's imperative that you reach out to your team now, and you may have to reach out a few times because your team may be getting inundated from calls, but it's imperative that you reach out to your team and make sure that now is the time to have a proactive plan in place to manage uncertainty, because the reality of it is if you don't have a prudent plan, you're setting yourself up for failure. And if you're an individual, failure looks like this. It impacts your family. If you're a business, failure looks like this. It impacts however many thousands of families that work for your corporation. So it is imperative that you have a plan, you have a team, you execute a strategy. It's better to have what if scenarios now as opposed to encounter scenarios that you're not prepared for. So, with that being said, I thank everybody for joining in to our broadcast, and we will be doing discussions around this. Feel free to share this on either Facebook or YouTube or LinkedIn, to comment, to share it with your network. This stream will stay on for you to watch afterwards. Feel free to comment in the post if there's other things or other experts that you want us to bring to discuss, or questions that you have about finances or what's going on in the economy. I thank you all for joining us, and I hope that you have a wonderful end to your week.
Thanks, guys.
Thank you, everyone.